California, we live in Orange County. So a lot of families have invested highly in real estate.
The first thing that I'll often talk to clients about is when I look at title, is the real estate held in a trust? And whether or not it is, that is something that we want to kind of work through.
If you haven't done any estate planning, California has a wonderful estate plan for you. It's called the California Probate Code, and it's awful. You are in an industry that gets sued a lot, like a doctor or an attorney. We want to do some asset protection. What doubled the tax code was Donald Trump's first tax bill from his first time around. So they have said they're going to extend that tax code.
Welcome. Thank you all for joining our webinar today. I have Blaine Birch here joining me to discuss. We're going to kind of cover a plethora of topics between 1031 exchanges, DSTs, real estate, and estate planning. For those who do not know me, my name is Ashley Romiti. I am a 1031 DST advisor. So my specialty is working with real estate investors and helping them defer capital gains on the sale of their properties and reinvest into passive funds. Those passive funds are known as Delaware Statutory Trust. I personally get a lot of questions from my clients on the DST structure and how really it plays a role into their estate planning. And that's why I've invited Blaine here to come and be the expert, tell us a little bit more about what either yourselves or what your clients should know as they're planning their estate and as they're structuring their real estate. So before we get started, Blaine, if you want to tell a little bit about yourself and how you work with real estate investors, that would be great.
Thank you so much, Ashley. I appreciate you having me on this webinar. I am a certified specialist in estate planning, trust, and probate law. I do estate planning. I do high-level tax planning and asset protection, all based in trust work. But in our work, we get all types of different assets. But we live here in Southern California. We live in Orange County. So a lot of families have invested highly in real estate. And so we get a lot of real estate investors. And then their questions, are around what type of planning do I need to do? What taxes affect me? How do I properly transfer these things to my kids? These types of properties for the least amount of tax hit. So we do a lot of the planning side, even though we're not really real estate investors. We're just doing it on the estate planning side. But yeah, we get to deal with it a lot.
Perfect. Well, and you brought up a good point. So, before we even get talking into about real estate and DSTs, I want to cover estate planning 101. And I know that's kind of the base of what you do. The first thing that I'll often talk to clients about is when I look at title, is the real estate held in a trust? And whether or not it is, that is something that we want to kind of work through. And so could you tell us why it's so important for investors to hold the real estate in the trust?
Yeah, so estate planning really is just putting in a plan to make sure that if something happens to you, everything can run smoothly, or at least as smoothly as possible. Now, part of that is if you haven't done any estate planning, California has a wonderful estate plan for you. It's called the California Probate Code, and it's awful because we live in California. Again, courts are overcrowded. They're not funded well enough. Judges don't have the time to spend on probates. So most of the time, it takes a long time to get in. Takes a long time to get powers. If you want to sell a house or a piece of property, you got to get court approval. There's a lot that goes into it if the court's involved. So we privatize that system with a revocable living trust. So basically, instead of having the court do all of that, we now have whoever you name as your trustee handle all of that. And unless there's an argument, it's not going to go back into court, right? Unless someone decides to sue over it, everything stays outside of the court supervision. And that allows everything to happen a little more smoothly with a lot less red tape.
Okay. That's not only for the real estate, but what are the other reasons for the trust to be on the real estate aspect?
Yeah, I mean, it's obviously going to control all assets, right? So bank accounts, retirement accounts, any type of asset that they have, the estate plan is going to do that. But the estate plan also handles the kind of more personal questions as well. Like, who do we want to be the person making decisions for us if we're incapacitated? Who do we want to take care of our kids if we can't? How much do we want to give to our kids so that, they don't become, just dependent on this inheritance? How much access do we want to give to our kids or to our beneficiaries based on whether they have financial spending problems or drug problems or anything else? So all of that, the family dynamic, as well as the assets, as well as the tax planning, all kind of gets grouped together into a plan.
Okay. And you touched a little bit on probate, but what's that timeline, assuming what if someone doesn't have the real estate within a trust? What would that family expect moving, over the next 12 months?
The first thing you're going to do is file a petition with the court to open a probate. And then there is a list in the probate code of the people that have priority to open a probate, right? So if there's a spouse, they would have first priority to open it. But if they don't, then, kids can do it, or aunts and uncles. There's a whole list, right? So once someone has opened probate and they say, I'm going to be the executor, there's a hearing to see if anybody objects to that. Hopefully no one does. If no one does, then they're named as the executor. However, that can take 6 months right there just to get named as the executor. So you've lost 6 months in being able to really manage any of the assets. Now their job is to marshal the assets, basically put their name on all of the assets as the executor. So you got to file deeds, you got to, contact banks and insurance companies and all that to get to marshal the assets into the estate. Then you can finally start to administer the estate. Yeah, so an estate with real property, you're probably looking at a 2-year probate at least.
So if you think about the real estate that investors hold, imagine this is what I would imagine. You have no control over for a few months, and what could really happen to that asset, in regards to the tenants. And it's just so important to have that set up so that you don't lose that value. The clients that I've worked with, they've spent a lot of time building their wealth and building their portfolios. And we want to make sure that at the end of the day, that is protected. Capital preservation is going to be number one in preparing that for their beneficiaries. So thank you for covering the basics on that.
In fact, we saw it at the end of in 2008, 2009, when the markets were crashing. People were wanting to sell the homes or the real property to get it to protect the value. And it took 6 months to get court approval. So it can really mess with the value of your real property.
Okay. Yeah. And with where we are in the market, I would suggest everyone kind of taking a look and preparing for whatever market we have here moving forward. On the DST side, so the clients that I work with, they are selling their investment properties and they are reinvesting into Delaware statutory trusts. It is a trust itself, but I do tell clients there are benefits to moving into the DST. And for those who are unaware, the DST allows for investors to come in and purchase fractional ownership in real estate. From an estate planning standpoint, the reason that we encourage this is, if you have a client who owns, let's say, a residential property and it's investment property and there's 2 beneficiaries or 2 children, what happens when that investor passes away and the 2 children have to come up with a decision on what to do with the real estate? Well, by investing in Delaware statutory trust, you can kind of remove that challenge because you can assign whatever share or whatever percentage to the beneficiaries that you would want. So if you have a client selling a property for $1 million with 2 children, they can then assign 50% to each child so that when the investor passes away, and I'll have you speak on this, Blaine, but from our perspective, that is a much more simpler transition of their estate than dealing with the real estate itself. So what I'd love for you to talk about is, your perspective on that, and then maybe even a story of something that you've seen happen when trying to pass that real estate down to the children.
Yeah, there's a couple things you brought up there that are really, important. The first one that I would touch on is, if you want your kids to never speak to each other again, make them co-owners of a piece of property and don't define the roles of who's managing it. You're asking them to litigate with each other. And so either find a piece of property for each one of them to have, or find another way to divide the assets. If your only asset is a piece of property and you basically give it to both of them, there's going to be arguments and they're not going to want to do the same thing. One may want to live there, one may want to sell it, one may want to invest it and rent it out, and you're just giving them a problem. You're basically giving them a partition action in this property. Another thing is, you brought up, kind of the client that passes away. Well, sometimes they don't pass away. Sometimes they're just kind of entering retirement. They've been managing real property their whole life, and now they don't want to. They want to go travel or do whatever in retirement. They don't want to continue managing real property. But they like the idea of being invested in real property. So, okay, let's transfer your management heavy real property into a DST through that 1031 exchange. And now you don't have the management issues. You're just the owner of a DST interest, which is paying you basically a dividend, right? Now you can go do whatever you want to do, and you don't have to worry about managing a piece of property. Same thing can happen when that person that does the management is removed from the picture. Many times the kids don't have the same skill set. They are not good with managing real property. They don't. Again, there's multiple of them, so they are arguing how the management is going to happen. So there's a lot of problems that can happen. Not saying it's going to, but probably in 90% of the cases, there's going to be a problem or some litigation between the kids if you put them in, if you tie them together. You know, I have three sisters. I love my three sisters. We get along very well. If we were tied together on a piece of property, I can imagine us arguing over it. How deep that argument would go, I don't know, but it would cause friction where there doesn't need to be friction.
Right. And you did highlight a few good points. The DST, it is a good avenue for those individuals who have owned the property for a long time and they're tired of managing it. And I will say today that there is a big gap in children wanting to manage that real estate. So being able to remove that problem, not only in the immediate, but also in the future, that's really where the benefit of the Delaware Statutory Trust can come in for these real estate investors. Okay, I'm going to kind of move forward. I have a handful of questions that I've been asked throughout the years that we'll just kind of go through these questions. If you're watching and you have questions that you want to present yourself, feel free. I do have the chat open and we will answer those as we move forward. So on the trust, when we're putting the DST or the real estate into the trust, we kind of skipped over this, but can you talk about revocable versus irrevocable trusts?
And we talked about probate, right? We talked about probate and having a revocable living trust. That is what a revocable living trust is for. So even though 99% of the trusts most of you have heard about and deal with are revocable living trusts, they only take care of that issue, right? Probate and putting in a plan. If it's any other type of planning, if we're doing capital gains tax planning, estate tax planning, asset protection planning, any other type of trust is going to be an irrevocable trust. And so there's myriad irrevocable trusts. There's one type of revocable living trust, but the revocable living trust is the most common and should be the basis of any estate plan. Anybody should have a revocable living trust. Now, if you have some other issue you're trying to address, like a capital gains tax problem, you're going to take a big hit in 1 year, right? Or an estate tax problem, you're over the exemption amount. You are in an industry that gets sued a lot, like a doctor or an attorney. We want to do some asset protection. We're going to build a irrevocable trust that deals with that specific issue.
Okay. I will say most of the time when I'm dealing with trusts, I do see the DSTs are held, we're usually dealing with revocable trusts. I don't frequently come across irrevocable trust. I don't know if there's anything you want to comment on being able to hold a DST in an irrevocable trust or the benefit, would there be any benefit to that?
Yeah, the benefit would be whatever that trust is planned for, right? So let's say you have someone with a lot of real property and they have an estate tax issue. Okay, well, we're going to build a gifting trust that is an irrevocable trust to hold assets for the kids and get assets out of the estate of the client to lower their taxable estate. Great. We can use a DST just like any other asset. And it's actually a great asset because, again, we're just assigning that DST interest. We don't have to do a deed. We don't have to do a whole bunch of other stuff. We assign the DST interest there. It stays in that trust. And now it's outside of the estate. So as it grows, as it pays out, all of that stays outside of the estate.
Perfect. Well, so we're talking about irrevocable trust, revocable trust. Can you talk a little bit about how the LLC would be held for the real estate versus the DST?
One of the things I always recommend to my clients is if they hold real property, you need to hold it in an LLC. And that's more of an asset protection vehicle than a tax planning vehicle, right? So LLC is there to make sure that if anything happens on the property, your other personal assets are not going to be liable to any litigation that happens to that property because it's now being held in an LLC and treated as its own company. So you get that corporate protection. However, you're still having the management issues. You're having to have a bank account and then pay yourself and report that and do a K-1 tax return and the whole deal with an LLC. Whereas if you have it in a DST, you basically removed that liability, right? You no longer own the property. They can sue the DST, but that's the manager of the DST's issue. That's not your issue. Your contract says, I'm going to get paid a certain amount, and I have a certain interest in it. So you basically removed the liability entirely rather than just protect it. So I think it's a great liability and asset protection vehicle while also removing the management.
Perfect. And I will just say, after this brief conversation, this is why I always tell clients to talk to an estate planner, because there are many different levels that they want to take to protect themselves. In regards to, the DST and the LLC and holding real property, one thing I want to note on is what we're discussing are 1031 exchanges. Most of the time, when an investor owns the real estate, they must do a 1031 exchange with the LLC. So what that means is that with their partners, whoever the partners are in that LLC, they all must come to the same decision in that 1031 exchange. Today, I see a lot of challenges with that because you have, 4 partners in their 60s who have 2 or 3 kids each, and they want to go their separate ways, and they can't, because in order to completely defer the capital gains, they must do the 1031 exchange with the LLC. So one strategy that I'm working with clients today is being able to have them invest in a DST and then doing a drop and swap with that LLC in the future. Do you ever come across that strategy with your clients?
What an elegant strategy. I love that. I have not done that one specifically, but I love the idea of it, right? To be able to take an asset that would be difficult to do a 1031 exchange, and then you're foreseeing the issues of multiple people, and you don't want to give them each interest in an LLC that's just going to cause problems. Transferring it, doing a 1031 into a DST and allowing each party to then do what they want with that interest. Definitely a great solution to that problem.
Yeah, so that's something you consider. I have, looked at title and seen 16 members in the LLC, and that's really what we want to help clients avoid, is simplifying the estate for them and relying on individuals like yourself to restructure that. So now we'll move in, a lot of my conversations are from the tax perspective. We've talked about the entity structure and the benefits. Why the investors decide to do a 1031 exchange is generally for a tax benefit. They want to defer the capital gains. They want to get that step up in basis. Actually, before I continue, will you cover a little bit of step up in basis for me?
So why do we defer taxes? Well, if we defer capital gains long enough, hopefully we can avoid them, and we avoid it through a step up in basis. So the way capital gains tax works is we buy a piece of property at a certain price. That sets our basis. So let's say we buy a piece of property at $100,000. That's now our basis. Over time, the value of the property raises to $500,000. If we were to sell that property at $500,000, we pay capital gains tax on the $400,000 difference between our basis and the fair market value, right? The way a step up in basis works is, let's take that same piece of property. We purchased it for $100,000. It's now $500,000, but I pass away while holding that piece of property in my estate. Well, it's in my estate. It's part of my taxable estate. It gets a step up in basis, meaning the basis, which was $100,000, gets stepped up now to $500,000. So if my beneficiaries then sell it the next day, the difference between the fair market value and the basis is 0, and those capital gains are 0. So great. We've just been forgiven a whole bunch of capital gains. Then the basis stays there. So again, over time, the property then goes to $1 million. There's a difference again, but the basis got stepped up to the date of death value.
Okay. And so on the DST, how will the DST impact the estate and tax liability of the heirs?
Yeah, so all assets, not just real property, get a step up in basis. So if we've been deferring taxes, right, capital gains, we've been holding a piece of property for a long time, and then we 1031 exchange it, that means the basis remains at that original basis. So we carry our basis into the DST. Okay, now there's a difference between the value of what we own in the DST and the basis we have in the DST. If we were to sell our interest in the DST, that's when we pay capital gains. But if we hold the DST in our estate when we pass away, that basis now gets stepped up to fair market value. So the value of our DST and the value of our basis now are the same. We sell it our beneficiaries sell it the next day, and there's no capital gains. So that's if we can defer those capital gains long enough to the death of someone that holds it in their estate, those capital gains are now forgiven.
Okay, and I don't know if you've heard of it. We call it swap till you drop, defer till you
Yeah.
die. Just a few fun, ways that you can look at it when we're
I
talking
like those.
about
Yeah.
our clients. And, we're having these conversations about what their beneficiaries, and we need to make sure that we're comfortable and they understand what that will look like. On the DST, I do want to highlight that they are a liquid investment. So if a client invests in a DST and it's a 5 to 7 year hold period, and the client passes away at year 3, the beneficiaries are going to remain in that DST for the remainder of those years. What would that do for them from a tax standpoint?
Yeah, so they still get the step up in basis, right? So now the beneficiaries, let's say mom or dad dies in year 1 of that 3-year period, right? We get stepped up to the basis gets stepped up, and now we've got to hold it for another 2 years, and then we can sell it out. We're going to pay some capital gains, but that original capital gains is still forgiven, right? We still got that full step up. That basis difference is going to be much less.
Right. And a lot of the clients that I work with, they've owned the property for decades. They bought it for $100,000. They're selling it for $3 million. So
yeah.
You're going to see far less of a gain in those few years.
You're paying a few $1,000s of capital gains rather than hundreds of thousands or millions of dollars. Yeah.
Perfect. Okay. And when my clients ask me what are the taxes that they owe then when they pass away, I usually defer to an estate planner. I say, that goes into estate planning and what the estate tax. What are our DST interests subject to estate taxes, and how could investors mitigate those taxes?
So we have a federal estate tax that is basically a death tax that is levied on the deceased. Okay, so it's not levied on beneficiaries, even though it's the beneficiaries that end up having to pay it because it's taken from the inheritance that they would receive. The way this works is right now it's a 40% tax on worldwide net worth. Okay, so whatever you're worth, you take all of your assets worldwide, bring them all together, value them all, and whatever that number is, that's the taxable estate. Okay.
I have to ask, are there any exclusions? We all hear about trusts in different areas. Are there any? Okay.
We're talking about U.S. citizens.
Yes.
U.S. citizens are taxed on worldwide assets, right?
Okay.
Now, there's planning to get things out of the estate, right? We know how to do that. But as far as what is taxed, your estate, whatever you own at the time of your death, that's your taxable estate. There's also a very high exemption right now. So every person holds almost a $14 million exemption, $13.99 million this year. So most people are not paying an estate tax because they have an estate worth less than $14 million. However, there are companies and real property investors and other people that have estates over $14 million. Doesn't take too much, especially here in Orange County, to get over that number. So what do we do? Well, there's all sorts of planning techniques. This is where the irrevocable trusts come into play. We can use ILIT, which is an irrevocable life insurance trust. We can use a qualified personal residence trust for your residence to reduce the value of that and get it out of your estate and use less exemption. We can use grantor trusts, which is just a different type of irrevocable trust where the client is the taxpayer for the trust, meaning that if we sell assets to the trust for a promissory note, there's no tax implications because you're the taxpayer on both sides of the transaction. So we do that sometimes. There are really myriad. This is where my planning comes into play. And there's lots of different avenues depending on how people want to do it. There are ways to move assets out of your estate and bring your taxable estate down to zero. The estate tax really is a voluntary estate for all but the just uber wealthy. You'd have to get into the hundreds of millions to billions of dollars to be in a place where estate planning would probably still be paying some estate tax. Now, if you don't do any planning, you're going to get hit with it. And that's where we see the problems. People that have businesses or hard assets that then have to sell maybe in a bad market to then pay the estate tax because that estate tax is due 9 months after the date of death. So it's a real quick turnaround.
So most of the clients all of the clients that I work with, they have to be accredited investors. So they have to have either a net worth of $1 million, excluding their personal residence, or if they have to meet certain income requirements. When we're talking about estate planning in general and the strategies that you can explore with them, is there a net worth that you would generally want to see or require a client, or would you say it's just kind of across the board and the strategy depends on what their holdings are?
A little of both, right? So with foundational estate planning and creating a revocable living trust for probate, that's almost for anybody in California, right? There's no reason not to have a revocable living trust. However, for other planning, now it's not so much it's whether it's worth it to the client, really. So let's say they are looking at selling a piece of property and they are looking to, avoid as much of the tax as possible. Well, we can do things like a charitable remainder trust or other types of trusts where we get different types of deductions, right? Other than a 1031 exchange that allow you to, sell the property and defer the taxes that way. If it makes sense to them, then that works, right? If they're going to take a big tax hit in a year. And then, like I said, if they have an estate over the exemption amount, then yeah, we're obviously looking at estate tax planning.
Okay, and that exemption amount, let's just remind, it's how much per individual?
It's 13.99 this year. It gets adjusted for inflation every year. However, right now, the tax code says that that's going to be cut in half at the end of 2025. But what doubled the tax code was Donald Trump's first tax bill from his first time around. So they have said they're going to extend that tax code. If they extend it all, I'm probably on the side that says it will be extended, but as of right now, it has not been, and it's due to be cut in half at the end of the year.
Okay, so it's a good year to really start planning. We went off topic into the estate planning a little bit. I'm going to circle back to DSTs. I want to try to be respectful and cut this closer to 30 minutes. So back to the DSTs, we're talking about the beneficiaries inheriting those. There's always concerns when individuals live in California on what are the taxes. We are a high tax state. Do beneficiaries who live in California, are they exposed to any additional taxes, or, can you speak to that a little bit on the state by state basis?
I would say the biggest issue with California and real property and taxes is with California real property and the reassessment of that real property for property tax purposes. We used to have a very large exemption that allowed us to pass real property down through the generations without it being reassessed for property tax purposes. And the way that works is when you buy your piece of property, you get a basis and the property taxes are set at that basis. And then it is just raised 1% to 2% each year, according to Prop 13, and does not get reassessed to fair market value unless you sell it or transfer it to another person. Now, we used to be able to do a parent to child. There was an exclusion for that. That's now almost entirely gone, and is entirely gone for anything but your residence. Your property taxes is the biggest portion and the biggest hit that people are taking right now as those things are being passed down through the generations. There is some planning we can do to avoid that, but a great way to get around it is to go into a DST. Transfer those California real properties, invest in a DST, which is probably investing outside of California. Yeah. And then all of those assets aren't going to be reassessed because that's a California law, right? So now you're not getting hit with those reassessment issues.
And that's a good point. Most DSTs today are not going to be within California. We are looking at more landlord-friendly states, more tax-friendly states.
Sure.
So if we look at inventory today, we still see your income tax-free states. So Florida and Texas, Tennessee. But we're also seeing more of the Carolinas, Georgia, the Midwest. Yep. And again, it's back to those more landlord-friendly states. And the DST sponsors, these are considerations that they're thinking about when they're bringing these out, because the primary investors who go into DSTs are those who are doing estate planning. They are those individuals who are preparing, the real estate for their children to take on and for their families. So yeah, something that to consider if you have real estate within California.
Yeah, and people don't realize how big of a hit that is, right? You've been saying people have been holding these properties for decades. They may be paying a few $1,000s in property taxes. It gets reassessed to $3 million or more. You're now paying $30,000 to $40,000 to $50,000 in property taxes every single year. So it definitely makes a big difference.
A lot of markets that we look at, your return on equity at that point would be very minimal. I think we'll kind of wrap up there. I don't know if Blaine, there's anything else you want to add. We've covered a lot in regards to estate planning and taxes and real estate. If there's anything that you want to add on, please go ahead.
No, this was great. I really appreciate it. This was a fun conversation, and I really thank you for letting me come on and talk about it.
Of course, and I want to thank you all for joining us today. If you have further questions, feel free to reach out to myself, or if you don't have Blaine's information, I'm happy to share that as well. And I hope you enjoy the rest of the day.
Thanks, Ashley.